Well, good morning. This is James Hecker, mortgage advisor, bringing you the weekly mortgage rate recap and forecast. And for the recap, well, interest rates started out better in the beginning of last week, and but then they ended up worse towards the end of the week. So basically what's happening there is that a couple of different factors are pushing interest rates up, and one of them is the action taken by the Bank of England. They are also fighting their own inflationary pressures, and they came out with an anti-inflation program that really was things that would traditionally stimulate the economy, which drives inflation. So they figured that out pretty quick, and very much the next day they changed course on that and repealed those basically tax cuts, and came up with some other ideas. So that kind of made a little bit of volatility the last week and a half or so in our market, and pushed rates up a little bit and then down. But then the jobless numbers came out at the end of the week, a little bit better than what was expected, and that's inflationary as well. So the bond market reacted accordingly with lower bond prices, which is higher interest rates. So what do we have to look forward to? Well, we have higher interest rates to look forward to. The Federal Reserve Chairman Powell had already said some time ago that he intends to raise interest rates to the point of really creating some economic pain. Raising interest rates to fight inflation has a negative impact. It contracts the economy and could throw us into recession. Some people would say that we are already in recession. Traditionally, recession is defined as 2 quarters of negative GDP growth, which we have seen. But other factors, such as improved jobless claims, as well as some resilience in the economy, it's basically being interpreted as we're not in a recession yet. And so the Feds recently said that they intend to continue to raise interest rates and then leave them higher for some time longer than what we had initially anticipated. We were thinking we might see some lower interest rates the end of 2022 and into the first quarter of 2023. The Feds are basically saying, look, we're going to keep interest rates higher even if we do cause that economic pain that we've been talking about through 2023. So we may not see lower interest rates until the end of 2023 or even into 2024. And so what does that mean? Well, first of all, affordability is an issue for people. Back in January, when mortgage interest rate was about 3.25%, you could buy a home of about $800,000, and you'd have a payment with 20% down in good credit of roughly about $3,800. Now, with 20% down in good credit and that same payment of $3,700 to $3,800 at today's interest rates, you're looking at purchasing power or a purchase price of about $550,000. So that definitely affects affordability. So, let's look for the silver lining. Where's the opportunity? The opportunity is in the fact that there are going to be fewer people in the marketplace, and so those who left the marketplace stopped looking for a home because of the competition with interest rates at 2.5% to 3% in that range. People just gave up. They were tired of being in multiple offer situations and getting beat out and paying more than what the seller was asking for. And so those people who can still qualify are going to find some opportunity in that, with lesser competition and a changing marketplace where sellers are more willing to negotiate. They might give you some closing costs, or they might reduce the purchase price a little bit, but they're certainly not sitting there receiving multiple offers of 20, 30 offers on a house in a frenzy where the price just goes up and up and up and up. That's not happening. So there's some opportunity there. And the other things that are affecting the market, we've got this coming this week, the CPI, the Consumer Price Index, that will be released on Thursday. And that's basically a determination of inflation. And we don't expect that to be a good number. And even if it is a good number, the feds have already said they don't intend to back off of increasing interest rates until they see good numbers for quite a while. So that's coming out on Thursday. On Friday, we're going to see the jobless claims again. And, there's still a shortage of people to fill these jobs. And so that's a number that we anticipate is going to be inflationary as well. So if you want to find out how this market affects you individually or affects someone that you care about, whether you want to buy a home or if you have equity in your home and you want to buy an investment property or a vacation property with the equity that you have, by all means, give me a call. I'd be happy to talk to you about your specific situation and how you can take advantage of some of the new programs and the things that are coming out to help with affordability and to help you take advantage of the opportunities that are in this market. So I look forward to speaking with you. 661-714-2145 is my number. Have a fantastic week.